Hey everybody, it's Seth and Paul for the Everything Money Show. Welcome in. We welcome in a bunch of new subscribers. Paul, it's been an incredible week, and we appreciate your support. In this video, you will learn what free cash flow is for a company. It's one of the hot topics we talk about during our live streams, in our Patreon. And if you're new or a young investor and you're wondering how to look at the health of a company, not just the stock price, you will learn about free cash flow right now. Paul, tell us about this metric of our 8-pillar analysis looking at a stock. Why is free cash flow so important to you, my friend?
So this is my favorite one, and we always talk about this, and it's also the one we get the most questions on. Would you not agree?
Yes.
Our comments on the YouTube channels are like, well, why do you have this multiple of free cash flow? I like free cash flow because earnings in and of itself on a year-to-year basis can be manipulated pretty heavily. There are write-offs that can happen that don't actually cost. For example, if I make an acquisition today for $10, it doesn't go as an expense because I'm acquiring a company. Let's say 5 years down the road, I realized the thing was worth zero. All of a sudden, we screwed up. That $10 is worth zero. The government will allow me to write off that full $10 in year 5. But I already paid for it in previous years. So it's showing a manipulation to the earnings later on. I like free cash flow because to me, free cash flow is after capital expenditures. What are capital expenditures? Capital expenditures are the investments you make back into your property, plant, and equipment in order to maintain or try to grow your business. Now, earnings, net income, doesn't factor in. When you make an investment back into your property, plant, and equipment, you cannot deduct it against your earnings. This is getting a little complicated, but from an IRS and tax perspective, if I have a company and let's say it makes $100 a year, if I invest $20 back into the business, most people would say, oh, you made 80 bucks. No. According to the IRS, you still made 100. But now what they let you do is they let you take that $20 and deduct it, a portion of it every single year for 5 years, like example. So instead, the first year, you get to deduct $4, which is 1/5 of 20. So it shows you made 96, even though your cash would have been $80 extra. So I like looking at the free cash flow to show me what the company is actually spending to maintain and grow its business. Now, what is free cash flow? Free cash flow is your operating income, operating cash flow, minus your capital expenditures.
Can you describe what both of those are?
Absolutely. I'm actually going to pull one up. I'm actually going to pull it up on the. I'm going to actually pull it up on our trusty Y charts. We're going to pull up Apple. Very popular company. Let's just pull it up. We go to the cash flow statement. And by the way, this is Y charts, which is very expensive, but we are creating the Everything Money website, 8-pillar website that'll provide all this data for you for a very small monthly fee. So I go to the cash flow statement. I go to the bottom of the operating cash flows, and I take cash from operations right here, and I subtract the capital expenditures, which is the first item of the investing section. Now, keep in mind, it's already a negative. So for you math people out there, it's adding a negative, or you just subtract out the absolute values. The bottom line is, last year, Apple had $73.3 billion in free cash flow, okay? You just subtract these two numbers, that shows you the free cash flow. I like to see growth from 5 years before, so it was around 43.5 up to 73.3. That'd be a check mark there. They have increasing free cash flow. So the next question is, okay, so what's the big deal about free cash flow? Well, free cash flow can be used to pay out dividends. Now, people love dividends because it's a way that a company who has so much extra cash and no way to reinvest it at a high rate can give money back to their investors so they feel good that they're getting something back from the company, no matter what the stock price does. Does this make sense so far, Seth?
Yeah, I mean, a lot of people are big fans of high dividend companies. We talked a lot about like AT&T and other ones. News to me this year was that these dividends are not set in stone. They're
not.
Move.
You get to look at the free cash flow to determine, can they afford the dividends still?
What else do they do with free cash flow?
You can do something, buy back shares. So when you buy back shares, a lot of times a company, as a way of rewarding previous investors or buying back inexpensive shares, they'll take that cash and buy back shares. What that means is, let's say a company has 10 shares outstanding and you own one of them. You own 10% of the business, right? Well, if they buy back 2 of the shares, there's now 8 shares outstanding and you still own 1. So now instead of owning 10% of the business, you now own 12.5% of the business. So it's a way of having existing shareholders who hang on to the shares over long periods of time to get kind of a better, bigger piece of the company as time goes on.
A company like Tesla is now selling shares. What is the opposite of that,
They're
Paul?
diluting their investors. So now if you have 10 shares outstanding, you own 1, you have 10%. If all of a sudden they issue 5 more shares, you have 1 of 15, which is around 6.5%. So they're diluting you. You're now owning less and less of the company as time goes on.
So this is one of our pillars. Pillar number 5 is we want the number of shares decreasing.
Yep.
Keep going, Paul.
So another way, so free cash flow is also used to make their interest payments on their loans. Okay, so companies have debt. It's their way of showing, can we make interest payments? There's another cash flow metric called cash flow for equity or something like that, where it takes the interest payments out of there. It's a good metric to look at. I don't remember exactly which one it is, but obviously you see I don't really look at it that much. I probably should, but I want to focus on the 8 pillars for you guys. But it's basically a way of paying, can they afford to pay their debt payments? So this is why cash flow is so important. Now, the biggest question we have is, one of our metrics is price to free cash flow less than 20.
This is pillar number 8. So
this is the 8th pillar.
Once we find the free cash flow average, you do this metric to do what, Paul?
So this is a subjective number. I picked 20 because our goal for PE ratio is 20. And over long periods of time, your earnings and your free cash flow should be pretty similar to each other. They shouldn't fluctuate. In fact, a lot of people look for frauds by seeing a company, Enron, if you looked at their free cash flow versus their net income over long periods of time, they were massively different, 10, 20 times apart. That was an indication of fraud there. So over long periods of time, they should be pretty close. How close? That's like, you know, horseshoes and hand grenades, right? There's that old saying of close only matters in horseshoe and hand grenades. I would sit there and say in free cash flow and earnings. So I pick a number, a multiple. We've talked about 20, but here's the point. If you're let me ask you this question. I always say this. Let's say you're buying a company with $2, $2, $2, $2. This is year 1, 2, 3, 4 of free cash flow.
In the future.
In the future. And let's say year 5, the business is 0. They shut down. I'm just trying to be hypothetical here. Seth, how much would you pay today for 4 years of $2 in free cash flow?
Well, you've asked me this a lot.
Yep.
And this is the fine line we walk. Is when we have some failing businesses, it still might be worth something.
Correct. Would you pay $8 for it?
No.
No. Why? Because why would you pay $8 to get $8 in the future?
Mm-hmm.
Right? Would you pay 6 for it? Would you pay 4 for it?
4 sounds nice.
Yeah, you're going to double your money over the next 4 years. The point of the exercise is say, there is some metric here that allows you to sit there and say, how much am I willing to pay today for a future stream of cash flow? The 20 metric is merely saying, I am willing to pay 20 times more, 20 times today's, the most recent free cash flow number in order to own the company. Okay, now, let's say the company was doing 2, then 4, then 8, then 16. Would you still pay $4 today?
Absolutely, right?
Right. Now, would you pay 8?
I don't know.
You're going to get 6, 14, $30 over the next 4 years.
I guess so.
Yeah.
Nice return.
Would you pay 10? Probably. Would you pay 15? You're going to pay 15 to get 30 in the next 4 years. I think you would. The whole point is when the free cash flow is growing faster and faster and faster, you're going to be willing to pay a higher multiple.
Ah, I got it.
That's the whole point about where we pick 20 versus 15 versus 30.
So if you look at our analysis on our channel, we've done hundreds and hundreds of videos. Our pillar number 8 is after we find the free cash flow, we multiply this times 20. It will get us our desired market cap we want to pay for the entire company. And a lot of times, in this day and age, a lot of these companies are way over with their market cap. They're too expensive.
Correct. And for the pillars, for the 20 number, it's more of a, remember, the 8 pillars aren't a buy or sell immediately based on these. It's more of a, let's throw some ideas out there. Does it come in the ballpark? Throwing out 20, and then let's say you come up with a number of the company's worth 50 billion, but it's selling for 200 billion. Don't go further, right? If it's 50 billion, if you sit there and multiply with 20, it's 50 billion, and then the company's selling for 55 billion, don't say no, but okay, that's pretty close. Maybe my 20 multiple is wrong. Maybe it should be 30 times. Okay, so then I use the same example. Let's say a company is going to generate 16, then 8, then 4, then $2 billion. So before, were you willing to pay 15 for the other way around?
Mm-hmm.
Now it's decreasing. Are you really willing to pay 15 for this? Maybe, I don't know. The whole point is if it's decreasing, guys, you're going to pay less of a multiple. Because remember, a decreasing business is still worth something. A decreasing cash flow is still worth something. So maybe instead of 20, you say, listen, it's going to 0. I'm willing to pay 10 times free cash flow. Okay, this is the art of investing. This is where you have to determine to yourself after doing your research beyond the 8 pillars, what's this company's future look like? Do they have good growth potential that can give me more return as time goes on? If the answer is yes, then you might be willing to pay a higher multiple than if the business is decreasing, if it's like a paper company. And I say that hypothetically because of Dunder Mifflin, the joke with The Office. If it's a paper company with decreasing free cash flow.
Can you pull up can you look up, let's finish this off with the analyzation of Apple. We'll do our last 2 pillars. We can look at free cash flow average and then relate that to our market cap.
Great, let's do that.
While Paul does that, make sure you guys are tickling the thumbs up button. We really appreciate. Our channel is exploding this year, Paul. It's been incredible. And with your support, we appreciate it. So you don't have to give us a dime. You can just smash that like. But if you'd like more insight, you can join our Patreon, Everything Money. It's our patreon.com/everythingmoney.
So I was wrong in the first number. 53.5, 51.8, 58.1, 58.8, 73.3. Okay, are you adding these all together?
59.1.
Okay, so let's call it $60 billion is the average.
So the free cash flow average over the past 5 years is $60 billion.
Now, it's grown a lot, but what's the future? That's the past. Is the future growth potential still there? So one of the things I'd look at is, let's look at their operating cash flow over time. It is growing a lot, but is the potential there? This is where you go into your analysis of the future of the company. What does Apple do in revenue every year? Let's look at that. Right now, Apple does $275 billion in revenue. Is it reasonable to assume the last 10 years are going to be just as good as the next 10 years? In the last 10 years, they've gone from 108 billion in revenue to 275 billion. Is it possible they do just as well? Sure. But that means the next 10 years would be, $600 billion or something like that in revenue. I don't know. This is where you have to decide what's that going to look like for you. I have no idea how they're going to grow in the next few years. And this is one of the assumptions you make in investing. What do you think will happen? What I do is I might model out several different areas. Okay, well, if they maybe get half of their last 5 years, or they match their last 5 years, or they do 75% of their last 5 years, how does it look? And that's how you have to determine it. I don't believe Apple should get a really high multiple only because of its size. But the brand is very, very valuable. People are immersed in Apple. That's worth something. That's worth a premium. So you have to weigh all these things together. Maybe it is 20 times that number, and that $60 billion number times 20 equals 1.2 trillion. But here's the deal. 1.2 trillion, even using a 20 times multiple, what are they currently selling for? They are currently selling for 2.26 trillion.
What does that mean, Paul?
So their market cap is 2.26 trillion. If you want to buy the entire company right now, buy out all their shares, you'd pay 2.26 trillion. That's basically selling, if their last 5 years has been 60, that's basically selling for 37 times free cash flow.
Too much for you.
To me, based on how big Apple is, it is not worth 37 times free cash flow. Maybe it's 38. The whole point is it's too much for me.
And how does that relate to the stock price, Paul, to sum it all up?
So then the stock price is the market cap divided by the number of shares. Now, they are taking their free cash flow and buying back shares. That will increase your free cash flow per share, but not the overall free cash flow. I like to evaluate the company assuming there's one share, and that's it. Buying the entire company at once. Because when you're buying a stock, you're buying a piece of the company. I don't want to sit there and only make money because of a manipulation of the number of shares. I want to make sure the shares aren't skyrocketing, but I want to sit there and say, okay, if I were to buy this company in full right now, what would I pay for it? And my answer is I would not pay 2.26 trillion. Because I think the future growth of Apple is not going to be as good as the past growth. Just based on their size, just based on a lot of other factors, it's going to be a very difficult road to try to equate the last 5-6 years of growth, the last 10 years of growth.
What stock price would you like to see Apple at before you're buying? Currently at 134.
So I have my trusty model. Let me show you guys my cute dogs right here. Oh, right here. So Here's my model. Now, the interesting thing is, guys, you have to sit there and understand that this is what a model does. It takes assumptions of yours. So the last 5 years, annual revenue growth has been 5.7% a year. That's not a ton. Their annual income growth has only been 4.7. So their income hasn't even grown as fast as their revenue growth. I would sit there and say, okay, so here's where I do a revenue growth discount. I put in 50% revenue growth. So it's assuming the next 5 years will be 2.85, 75%, and 100%. Profit margin, 75, 87.5, 100%. My guess is the profit margin in Apple is probably going to stay pretty similar. So I'm going to go ahead and sit there and probably put 90%, 95%. And now, net present value. So in this model, I have to determine how much am I discounting all my future cash flow. So it's basically the return I want to get. If 15% is the return, historically the average is 10%. So let's put 10% in there. And I'm putting a future price to earnings ratio of 15 in there. Can you put 18 in there saying, well, Apple's a very premium company. It's yes, sure. If that's the case, it's showing me a high price of $67 and a low price of 52. So it basically has to fall in half for me to even be interested in where I want to be at. And that's just the way I look at it. I'm doing a present value of the next 5 years of cash flow. Now, I might expand this to 10 years, but again, the longer and longer you go, especially for Apple, when it grew so fast years past, I think it's going to be skewing the numbers to a higher level. So am I interested around 60 or 70? Yes. At that point, I'm going to start looking at it further and deciding, what do I want to do? You might sit there and say, Paul, that's going to fall. Apple will never fall in half. Well, I might remind you that Apple has fallen in half several times, even in the last 20 years, as it's rebounded and done very well. The whole point is, Apple's not the only company out there. I do believe there should be a premium paid for certain aspects of Apple because they're immersed in everybody's life. We joke and say, why do you not have an iPhone, et cetera, right? So everybody has Apple products. Even me, I'm a PC guy. I still have Apple products. So I look at these things saying, this is part of the art of investing. You never know the exact metric. But at the end of the day, I'm looking at Apple saying, maybe it's a $60 or $70 company to me. But remember, I'm a value investor. I want to buy for way lower than what I think the value is. I'm determining the value to be around $60 or $70 a share.
If this in-depth analysis using math and numbers resonates with you, as opposed to some of our competitors on YouTube who are just saying if the price is going up, we should just absolutely buy it because it's always going to go up, you're in the right place. Paul has been doing this analysis. We have been doing this analysis for many years now, and we will continue to do so with your support. So make sure you smash the like up. Paul, make sure you smash the like button. Paul, thanks for your in-depth analysis there of free cash flow.
Thank you, sir.
See you guys. Appreciate it.